But first, BNN's top line. Warnings are piling up today about the country's real estate industry. Canada Mortgage and Housing Corporation identifies Toronto, Regina, and Winnipeg as the highest risk markets. CMHC says the problems include overbuilding and runaway prices. The housing agency's review comes amid red flags from Canada's largest home builder. A top official from Mattamy Homes tells BNN the housing market could face a day of reckoning when the inevitable happens and rates rise.
The home building industry has really responded to a consumer who now thinks of housing as how much does it cost per month, not how much does it cost. And that's a little bit scary because at times when you think about where interest rates are likely to go, we could suffer some real pressures as people struggle to afford these houses as interest rates rise.
For more on how Canada's high-risk housing is stirring concerns, we turn to our real estate reporter, Greg Bonnell.
Last time the Canada Mortgage Housing Corporation gave us this assessment of the situation in Canada was in the spring, and Toronto was only at a moderate risk rating then. Now it has been raised to high, and it's been raised that because they basically say this rise we've seen in Toronto home prices is not being matched by personal disposable income. Take a look at some of the numbers. In July, the average selling home price was up 10% year over year. For single-family homes, which the CMHC points out really driving the price acceleration, they're up 13%. I don't know anyone who got either a 10% or a 13% raise in the past 12 months. But indeed, that's the hike we're seeing, despite the fact that we've seen a single-family home in Toronto downtown hit $1 million for an average selling price. CMHC says they still see a modest risk of overvaluation. They say high prices by themselves don't mean overvaluation, which leads to the question of Vancouver. We know prices there even higher, even harder for people to get into the housing market. They say at the CMHC they don't see overvaluation there, and they continue to see low risk. Why? They say the demand is supported by a growing population and wage gains. But Regina, Winnipeg, the same reason as Toronto, the wage growth there just isn't keeping pace with the home price acceleration.
I'm not a big fan of talking to real estate agents about the health of the real estate market, but it's refreshing to hear a builder have some pretty significant concerns.
And that was surprising for me when I went out and did that shoot with Mattamy Homes and the Canadian President Brad Carr. We were basically talking, you can watch the online, I believe, later in the show, you'll see it, all the costs that go into building a new home. And then he starts telling me about the concerns that he's having. And he says, basically, it's that interest rate environment. People are going and they're saying, I can afford a $700,000 home. No, they're looking at what can I afford to carry a month based on today's interest rates. Mr. Carr telling us when you think about where interest rates are likely to go, they could suffer some real pressures as people struggle to afford those houses as the interest rates rise. So as you say, for a home builder to say that, that's quite a different thing from a real estate agent.
Right, okay. And as far as that segment you did on Mattamy Homes, we'll be playing that segment a little bit later on in the program. But if you can't wait, bnn.ca?
bnn.ca, it's all there waiting for you.
All right. Greg Bonnell.